All right, let's dive right in. Today, we're doing a full financial health check on a business. Think of it like a trip to the doctor, but for a company. We're going to pull back the curtain on the key documents, the financial statements, that show you what's really going on with a company's health and performance. So let's get to it.
So how do you really know if a business is healthy? I mean, you might see a busy cafe or a super slick website and think, man, they must be rolling in it. But is that the whole story? Not always. Appearances can be pretty misleading. The real story, the truth about a business's health, it's not on the surface. It's all in the numbers. And that's where financial statements come in. They're the official reports that give us the inside scoop. To do this health check, we really just need two key documents. First up, you've got the income statement. The best way to think about this is like the highlight reel of the business's year. It tells the story of its performance over time. Then, you've got the balance sheet. Now, this isn't a video, it's a snapshot, a single detailed X-ray of the company's financial health on one specific day.
Okay, so let's start with the story. The income statement, sometimes people call it the P&L for profit and loss, is all about answering one single crucial question. Over a certain amount of time, like a year, did this business actually make any money? It's all about profitability. Every story has a beginning, and for the income statement, that beginning is revenue. This is pretty simple. It's all the money the business brought in from doing what it does, selling its stuff or providing its services. It's the grand total of cash flowing into the business. Just think of it as money. Of course, as they say, you gotta spend money to make money. And that's where expenses come into the picture. These are all the costs the business had to pay out to make that revenue happen. We're talking salaries, rent, supplies, the whole shebang. So if revenue is money in, this is all the money out. So the heart of the income statement is just some really simple but incredibly powerful math. You take all the money in, that's your revenue, and you subtract all the money out, your expenses. And whatever's left, that's the bottom line. That's your profit. Or if things didn't go so well, your loss.
And that's the whole game right there. It's that simple. If the money coming in is more than the money going out, you've got a profit. If it's the other way around, you've got a loss. The entire point of this whole statement is to land on that one critical number. Okay, let's switch gears to our second document. So if the income statement was the story of the year, the balance sheet is like a photograph. It's a picture taken on the very last day of that year. It's not about performance over time, it's about where the company stands at one single moment.
So what is this snapshot actually showing us? Well, it boils down to two very basic things. On this one specific day, what does the business own and what does it owe? If you can get your head around that one idea, you've basically cracked the code of the balance sheet.
Now, I know what you're thinking. You see an equation and it looks a little scary. But don't worry, this is the most important equation in all of accounting. It's the one rule that guarantees the balance sheet always, balances. All it's saying is that everything a company owns, its assets, has to be paid for by something. And that something is either money it owes to other people, its liabilities, or money invested by the owners, their equity.
Let's break that down real quick. Assets? That's all the good stuff the company owns. Think cash, machinery, computers, inventory. Liabilities? That's what the company owes to other people, like bank loans or bills it hasn't paid yet. And equity? That's what's left over. It's the owner's piece of the pie, their stake in the company.
Okay, so we've got our story of the year, the income statement, and our snapshot in time, the balance sheet. Now, you might be thinking these are two totally separate reports, right? Nope, they are deeply, deeply connected. And figuring out this connection, well, this is the real aha moment. This is where it all clicks. So check this out. Let's go back to our income statement. Imagine our company had an amazing year, and the final bottom line profit is $50,000. That's great news, right? But what happens to that 50 grand? Where does it go? It doesn't just, evaporate into thin air. That profit is real. It represents a real increase in how much the company is worth. So the million-dollar question is, where does this $50,000 show up next in our financial health report?
And here's the answer. That profit, that 50 grand, flows directly from the bottom of the income statement and lands right inside the equity section of the balance sheet. This is the bridge. It connects the story of the year to the snapshot at the end.
The profit you earn all year literally makes the company more valuable on that final day.
Here's exactly how it works. So at the beginning of the year, let's say the company had $20,000 in something called retained earnings, which is just a fancy name for profits from past years that were kept in the business. Well, our $50,000 profit from this year gets added right on top of that. So retained earnings are now $70,000. And look what that does to the total equity, the owner's total stake. It jumps from $120,000 to $170,000. A profitable year directly increased the net worth of the business. It's that direct.
So we've gone through the mechanics, but why does this matter to you? What's the big takeaway? It's that now, just by looking at these two documents, you have the power to check the core health of almost any business, one you might want to invest in, work for, or maybe even start yourself.
You're now equipped to answer the 3 most important questions. Number 1, is it profitable? Easy. Just look at the bottom line of the income statement. Number 2, is it stable? Can it pay its bills? Just compare its current assets to its current liabilities on the balance sheet. And finally, number 3, what is this company truly worth to its owners? That's right there in black and white. Total equity on the balance sheet. Bam, bam, bam. You know where to look.
And there you have it. Just like that, you know the fundamentals. You have the tools to read a company's financial story and check its vital signs. So I guess the only question left is, whose financial health report are you going to look at first?